Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. They also cover stuff like the bond market. Ira Jersey, a Bloomberg Intelligence chief U.S. interest rate strategist, joins us now. The two-day move that we've seen in the back end is tremendous. What happened?
Yeah, I think most of this is a liquidity issue. So if you look at dealer balance sheets, they're stuffed with bonds. And, given that the long end has a lot of duration risk and market risk, and you have to hold a lot of capital against those trades, it seemed like there was just, there was some outflows and people trying to sell that long end paper, and the dealer community just couldn't absorb it. We've had this disintermediation where high frequency traders and some non-dealer actors have tried to act more or less like dealers, but they don't step in front of a train like we had yesterday. So I think that's one of the reasons why you had this massive volatility. And look, yes, it was a very big move. In the 30-year, it was the 9th largest daily range, so high to low in terms of the Treasuries in the last 25 years. So definitely a big move, but not like unprecedentedly big, right? It wasn't like a thing that we've never seen in our lifetime. But at the same time, like it does bring up the fear and the worry that a lot of the market structure changes that occurred a decade ago with Basel III and with some of the Dodd-Frank regulations, the issue with all of them is that they make the institutions, like the large banks, safe and sound at the expense at sometimes of balance sheet elasticity and therefore market liquidity. And that's what I think was a big reason why you saw such dramatic moves yesterday and probably a bit of the follow-on today.
So that's kind of where I want to go to, Ira, the liquidity in the marketplace. I mean, I remember my first day at Solomon Brothers. They walked me out onto the massive trading floor, and it was literally row after row after row of government bond traders. That's all they did. And that's liquidity to me. Is that still there at all?
It's not to the same extent that it was, and certainly even when I was on, working for one of the primary dealers, they had shrunk their footprint in terms of what they were trying to do in terms of taking risk, right? So, dealers are trying to match trades, match orders, all of those things, and one of two things has to happen if you're just trying to have the market deal with, client to dealer to client type of trades, and that's that you have to widen bid offer because, and if you can't inventory to sell, which is what a lot of bond dealers have done, particularly in the corporate bond market and some of the structured products markets, but in the Treasury market, that's true to some extent as well. You need more balance sheet to be able to do that. So that means you have to hold more equity, and liquidity can be very fickle. So everything looks great until you have just a certain amount of risk that's trying to be laid off at one moment, and that's when you get these massive moves. There's a simple fix, at least temporarily, and that would be to exempt Treasuries from the supplementary leverage ratio of the large banks, because most of the large banks have dealer arms, and by exempting the Treasuries from the SLR, which is a benefit to the government, right? It would be in the government's interest to do this. You would increase liquidity across most of the fixed income world, but Treasuries in particular, obviously, because you can now own more Treasuries without having to worry about this extra capital that you have to hold against them.
Such a good point. Here is my insanely smart question.
Oh, boy.
Why were there so many sellers yesterday?
Yeah, I think there were a couple of things going on. I mean, tariffs are a big one, right? There's people who are worried that given that about a third of the Treasury market is held by foreigners, that with less dollars leaving the U.S., that there'd be less demand from foreign entities. Now, in aggregate, foreigners haven't been net buyers of Treasuries, but private investors have been very large buyers of U.S. Treasuries. Central banks have been shedding their Treasuries, while private buyers have been purchasing purchasing. And why? Well, if you're an insurer who insures, oil on a ship, you have to own some treasuries or some other U.S. assets because you have a dollar liability. That's the oil that's on that ship. Now, what happens if that oil winds up being denominated in another currency for that transaction? You'll have to hedge it using that other currency. So I think there is this little bit of a fear that the U.S. dollar, because of everything that's going on, might lose some of its reserve currency status. Now, it's not going to happen overnight. It's not going to be, something that's going to happen within the next year even. But over time, there could be alternatives that crop up. The issue with, I think, the dollar story, and look, R.J. Child-Freeman, my colleague and the leader of our FX strategy team here at Bloomberg Intelligence, she's the expert on this by far. But the way that I view it is that the dollar over time, can lose its status against maybe the euro. Maybe there's more renminbi trades. The problem with all of those things is that you have to have very stable currencies, and you have to have enough debt for people to be able to, or assets anyway, for people to be able to purchase them in the open market, or otherwise you can't be a proper reserve currency the way that sterling was for a long time and the dollar has been since World War II.
Ira, great context. Appreciate it. Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Well, joining us in studio, he flew all the way here just to have this conversation, is Chris Watling, CEO and Chief Market Strategist of Longview Economics. Chris, there's lots of questions to get into, but let's just pick up on what Ira's talking about and the worries that the dollar could lose its status as a safe haven currency, as a world reserve currency. How real could that be in your world?
I mean, clearly it's being chipped away at the edges with the latest policy announcement with the tariffs. But I wouldn't want to overpin a one-day move. I mean, it looks to me more like maybe there's some forced liquidation for some sort of reason, some sort of funds blown up. There's been a lot of volatility. If you think about S&P moving 8% in one day, there are all sorts of things happening in portfolios yesterday. So, yeah, I mean, I think the bigger picture is U.S. exceptionalism was a well-accepted theme at the end of last year, and now it's being chipped away at quite heavily by the sort of policy announcements we see, particularly what we saw last Wednesday.
So what does that mean for maybe your economic growth forecast? I mean, both for the U.S. and globally, there's a lot of folks we're seeing bringing their estimates down for GDP growth and maybe even taking their inflation estimates up. What have you been doing?
Well, I mean, we've been talking about this idea of a mid-cycle slowdown for the last few months because I think Trump's initial policy agenda is negative for growth. But it does get better later on in the year as you get maybe some tax cuts into next year and some deregulation and so on. So I actually think the market's almost, the sort of fear's gone too far. It's as if, the price has driven the fear to be on where it should be in terms of recession calls and that sort of stuff. There is a lot that's good about the US economy. There's a lot of the private sector that's healthy. But, to answer your question, I mean, I don't think there's going to be a lot of growth in the sort of middle of this year.
So what do you do on a day like today? Is this a day to sell into the rallies? You want to sell the rips here?
No, I think it's a day to buy. So, I mean, it depends on your time frame. Sure. But tactically, we started buying this morning. I wish we'd started doing it yesterday, frankly. But I think there's, if you look, when do you want to buy on a tactical basis in the market? You want to buy when everyone's panicky and fearful. And that was yesterday. That was a sense of a liquidation event. The market had been selling off for almost 2 months. It was 20% lower. I mean, that's quite a move. 20% lower prices in a small recession. I don't think it's going to be a recession. And I think we've had the sort of shock of Wednesday, and now we're into the sort of nip and tuck of negotiation and sort of ebb and flow. I mean, some news flow will be better, some will be worse. So I don't think it's the end of the economic world for America. It's not good. I don't think it's a great policy, but it's not the end of growth. It's not the end of the S&P 500 and so on.
What were you buying, or what are you buying? Is it some of the tech names that have been such the leaders of this marketplace, or is it maybe more value?
I think if you're a trader, you buy the tech names because what went down the hardest bounces the hardest. But I think if you're an investor, you buy the cyclical stuff in the market because the shape of global growth is changing going forwards on a 6 to 18, 24-month view.
Do you need to do it in a nationalistic way, in that you want to buy companies that are exposed to the country in which they actually operate? Like, is that going to be the way to think about things going forward?
Maybe there's a bit of that, but I think what the shape of global growth is changing, in that I think we're going to get the Western consumer waking up. We've had a very weird post-pandemic world.
Wait, we're waking up? I thought we were going to sleep.
I don't know what you guys are doing, but no. I mean, in terms of so if you look at a lot of the Western economies, including the US, it's really, a lot of it's really struggled for 2 or 3 years. Even parts of the US, think of housing activity, it's on the floor. I mean, it's terrible. We need lower interest rates, and that's what we're going to get out of this. And lower interest rates, monetary policy is going to stimulate Western consumers, I think, to really get going. I'll give you one stat. There's $35 trillion of housing equity in US household balance sheets, net of mortgage debt. And that was like 10 trillion 15 years ago. There is a ton of money and wealth waiting to be tapped. You just need the right macro environment. And I think we're moving towards that. It's a similar story in the UK, similar story in Southern Europe. And parts of Europe as well, Northern Europe, are doing some good things.
30 seconds left. You mentioned Europe. That had been a very nice place to start the year relative to the U.S. S&P 500. Is that still a play for you?
I think it's still a play for us. As always, at the end of sell-offs, everything gets sold.
Yep.
It's indiscriminate. But yeah, I like Europe. I think there's a lot going for it. Germany's changing. Yep. Southern Europe looks terrific. They've been deleveraging for 15 years. We're getting lower interest rates. You're getting a defense fund. It's a long old list of positive factors, cyclical and structural, about Europe. So what Trump's done is he's woken the rest of the world up to get on with growing their own economies.
Yeah, I guess so. I mean, we saw that out of Germany, maybe close to $1 trillion of spending on defense and infrastructure. So we'll see how that plays out across Europe. Chris, thanks so much for joining us. Really appreciate it. Chris Watling, he's the CEO and Chief Market Strategist at Longview Economics, joining us live here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, thanks so much, Charlie Pellet. Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered on all the bases, internal and external sourcing. All right, we got a pretty fierce rally underway here. My question is, does it actually last? Nancy Daoud is private wealth advisor at Ameriprise Financial, and she joins us now, also CEO of Opus Advice First. Nancy, I appreciate that you're going to be a long-term investor on this, but just with our decades of experience here, when we take a look at a market move like this, after oversold conditions, does this bounce last for a while?
Well, it's hard to predict, obviously, but I do expect a great deal of turbulence. I mean, there's no doubt that this was somewhat expected, maybe not to the degree that it occurred. The first quarter was like feast and famine, and the first half of the first quarter was phenomenal. And then the second half just took it all back. So the Magnificent Seven stocks that had propelled the market prior are the same stocks that dragged it down. However, like you said, longer term, I still feel that we should be bullish. And in these turbulent times, although it was much more severe than expected, we should really look at this as much more of an opportunity, because up times last a lot longer than down times. And we just lose sight of that when things are so scary, like they happened in the last few days.
So how does one reposition, Nancy, if at all? Do you just kind of stay the course with your portfolio allocation? Do you try to maybe buy some things that were now more attractive? How have you kind of altered your view, if at all?
Well, clearly staying the course or time in the market has always been trying to time the market, because we have no idea if we've hit bottom or not. And if so, how do you time that? There's no way to do that. However, if you do have longer term goals and some excess cash that is available that you are willing to invest in the longer term, there's such an opportunity. I mean, the sectors that have taken the biggest beatings are financials and technology. So that's certainly an opportunity. And we know that ultimately those things will come back. Just don't know when. But I think the biggest message is that in the near term, there will be significant volatility.
That's to be sure. The idea, though, that we go back to what we knew before, is this time different? I mean, is the U.S. exceptionalism the rush into U.S. assets we've seen over the last decade. What's your level of conviction that that still holds?
I can't claim to be an expert on politics or economic policy, but I do know, having been around a very long time, is that history keeps repeating itself with the markets. The underlying variables may be very different each time, but ultimately the math rules, because that's how markets work. And so we may have a lot of emotion due to more information and a lot of propaganda, both positive and negative, coming at us. But ultimately, things level out and revert to the mean, because the math will always rule in the end. And that's when you're buying a stock in the market, you're buying the balance sheet of that company. So corporate earnings are important, and corporate profit and economic profit fundamentals are always going to be the determinants in the end. And those right now are actually quite solid. Now, can tariffs have a negative impact? Absolutely.
So, Nancy, how does fixed income work into your outlook these days?
Well, if you've gotten into fixed income in the last few months, you're feeling pretty good, because that has been a very big stabilizer in the last few weeks with all the turbulence. And I think fixed income prospects look pretty good. Just watch the duration and go for investment grade. But it's very likely that the Fed will cut rates again. We just don't know when and how much, but probably at least a couple of times this year. And I think it's certainly an opportunity with stabilization and diversification of a portfolio at this time.
Nancy, thank you so much for joining us. Always appreciate getting a few minutes of your time. Nancy Daoud, private wealth advisor, Ameriprise Financial, joining us from Miami, Florida via Zoom here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, let's go now to the effect of President Trump's policy on, say, green energy transition. Today at 3 o'clock, he's supposed to sign some executive orders to push forward coal production here in the U.S. Want to go to David Flackel, Bloomberg NEF lead U.S. policy analyst. NEF is originally known as New Energy Finance, or the team within Bloomberg that tracks and analyzes the energy transition. What do you make of this executive order coming today at 3 o'clock on coal, and what does it mean for the broader transition?
Well, the executive order is interesting because this is sort of a replay of what Trump tried to do in his first term, right? He had previously talked about increasing payments to or using emergency powers for preserving existing coal plants, maybe bringing old ones back online. And as we can see from the power generation data, that didn't really work out. Coal is now 15% of generation in the U.S. Per year, down from considerably higher levels before. So there's a lot of different moving parts to this. You might see more, say, coal exports, more long-term gathering of coal leases, which have been sort of moving back and forth from Obama to Trump 1 to Biden and now to Trump 2. But in general, it's hard to say that this will be a huge boon to coal build out or restoration, especially when you have tariffs weighing on any kind of big capital project.
All right, so talk about, the energy ecosystem. Where do we get stuff for the energy ecosystem, whether it's fossil fuels, clean energy? Where do we get the equipment? And is that something that's going to be impacted by these tariffs?
Very heavily. Even for fossil fuels, which are often a very domestically extracted resource, there's reliance on steel, aluminum, specialized equipment that's imported, which is why you saw the Dallas Fed register such negative opinions about the tariffs coming in generally. More broadly, in terms of, say, solar equipment, that mostly comes from Southeast Asia because we've had tariffs on China for a long time. Batteries themselves tend to come from China. Electric vehicles are imported from a variety of places, but especially, it's very domestic, but a fair amount of Canada and Mexico in there. And lastly, if you're thinking about, say, offshore wind, that's pretty dependent on Europe. The only thing that's really effectively onshore and minimally dependent on trade is onshore wind in the U.S.
What is the future of offshore wind in the U.S.? I mean, if we're talking about ramping up coal and sort of there's zero love from the administration on offshore wind, have we seen sort of I don't know, leases or any contracts be broken, or do you feel like companies that are still committed to the longer term world of offshore wind?
Well, I mean, what the offshore wind companies will tell you is this is a multi-year, long-term process of building that's beyond any one administration. We have seen one lease be canceled by the federal government for an ongoing project. But generally speaking, we haven't seen a lot more movement for things that have already been permitted and leased. Now, that's important because the federal government has a lot of leverage over that process. We're not seeing a lot more being added to the pipeline. But the real issue is going to come in the form of costs, inflation, and also potentially interest rates. We saw a major slowdown in offshore wind under Biden, which is a very supportive administration, simply because the cost of inputs went up, and as inflation went up, the Fed hiked rates. And wind is a very large capital-intensive project category and especially sensitive to those kinds of things. So if the tariffs lead to those broader impacts, we might see some fairly negative results for even the offshore wind projects that are already allowed to go forward.
Derek, I think even folks that are, that question the value of the economic value of tariffs in general, they kind of recognize that some of this strategically important stuff, maybe that we learned was strategically important from the pandemic when the trade, the cycles were all disrupted and the trade routes were disrupted. That makes some sense. Is it clean energy? Did they have a focus on bringing this stuff onshore as much as possible?
There's been a lot of discussion of that across multiple administrations. The Biden administration was in favor of that. The Trump administration is in favor of onshoring manufacturing generally and of energy security, independence, even dominance, as they like to say, generally. But that's a hard thing to achieve with tariffs alone. Ultimately, a lot of the solar factories, battery factories, EV factories that are coming up in the U.S. are dependent on imports, whether those are imports of upstream components or of the manufacturing equipment needed to make the final products, solar panels and batteries themselves. And right now, we're seeing costs go up on those across the board. Unless you have more reliable revenue streams, like tax credits, for example, it's kind of hard to imagine new decisions to build that stuff out. Even things that are already being built are facing uncertainty, not only from the Trump tariffs, from other investigations into tariffs being run at the Department of Commerce and U.S. Trade Representative, but also on the fate of those tax credits, which is going to help guarantee their revenues in the long term.
Yeah, it was a great point, which leads us to the IRA, the Inflation Reduction Act, which, I mean, clearly President Trump hates that thing, but there is a lot of value in it through the tax credits and subsidies for companies that supposedly he is a fan of, like the oil industry, for example. When do you think we're going to know the fate of the IRA and those tax credits?
That's a great question, and I've been wondering it myself. Obviously, we're seeing a lot of wrangling between the House and Senate today about the top lines on their big budget bill they're going to try and pass by the end of the year. Obviously, the end of the year is when individual tax rates go up, and so that's one of the big forcing functions. You also are seeing the X date, the debt ceiling, occurring somewhere between July and maybe September, and that's going to be a point where there's going to be a lot of pressure to pass a big budget package, raise the debt ceiling, and probably also get some of this tax material done. But we've seen a lot of deadlines blown already for when we were allegedly going to get top-line packages, which are a precondition to figure out what's going to happen to what tax credit. And we don't even know that yet. At this point, we don't even know if they're going to use this particular budget gimmick called current policy, which would really reduce the pressures to cut more. And as they're trying to use that, we're seeing a lot of blowback from fiscal conservatives in both the Senate, but especially in the House. And so we'll see.
All right, Derek, I think a lot of folks in the marketplace are saying, we'll see. We're not sure what's going to happen here. So,
how long can you put off a business decision with we'll see?
Yes, exactly. Derek Flakel, a lead U.S. policy analyst for BNEF, really a smart guy. So I was shocked to find that he went to the University of North Carolina. But every once in a while, somebody will pop out of that system and surprise you to the positive side. So, but I would think that these tariffs are going to be. It doesn't feel like any company can really escape the impact.
No.
I mean, because there's so many countries that are so broad-based, at least at this point.
And then it also just makes me wonder how the contracts are already set up with your suppliers, right? And who bears that commodity cost at the end of the day? And if it's going to be a solar company or a wind company, that's really rough. We saw that with offshore wind during COVID and that supply chain crunch, and that's basically what turned the tables against offshore wind economically.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.